All right, hello and welcome everybody. How are you all doing today? I hope you're doing spectacularly well on this Sunday, enjoying your afternoon, relaxing, and hopefully you are tuning in today with the intent of learning some great information because that's what I have for you. If I haven't met you yet, my name is Jason J. Hamilton and I'm the founder of this group. I am a chartered retirement planning counselor, and every Sunday right about 2 o'clock, we're going to bring you training that's going to help you retire with confidence and give you the knowledge you need to make good decisions when it comes to being smart with your wealth, with your money, and with your retirement planning. So that's what we're here today to do. So today we're going to have a really good discussion, I think, around required minimum distributions. And then for those of you that are not 70 and a half, which as we'll talk about is the age you need to start taking those, we're going to talk a little bit about how to reduce the required taxes that you're going to have to pay when you are going to be starting to take your your minimum distributions. So, should be a really, really good training for you today. As always, if you have any questions, drop them down in the comments. And after the training, I will jump in and do my best to answer your specific questions if they do apply to this. If they're completely off topic, I'll be honest with you, I'll probably tell you to post it. But if they do apply to our training today, then that's what we will be talking about. So let me just double check. If I can get you guys to comment down below to make sure the sound is working and that you can hear everything, just say yes or Y somewhere down in the comments. I'd really appreciate that. Looks like it is on my side, so it looks like it's okay. Let's see. Okay. If you guys can leave me a comment, let me know that everything's working. It should be good. It looks like it's working on my side, but I do want to confirm that everybody can hear and that you can see me okay and that everything is working perfectly, because at least once in the last 30 days each month, I've had some sort of weird technical issue. So it just is what it is. When you're going live here on Facebook, it's just like being on live TV. Really, if things go bonkers, you just have to deal with it and roll with the punches. So hopefully I don't end up in a blooper roll someday, but you never know. But what I want to do is just have fun here. I want to give you some good information, some good knowledge so that you can retire with confidence. So before we get into that, just as a reminder, if you have friends, if you have family members that you think will benefit from this group, please invite them in. A lot of you have been inviting friends and family. You're more than welcome to. What I do ask, though, is that after you invite them, that you actually tag them in a post so that they realize they're in the group. Because if you just add them in, they may not realize that you're actually in the group. So invite your friends and family. We're just over 2,000 members now. My goal is to be at 10,000 by early next year. And so the best way to do that is to get your friends and family in. And then you can also talk about the things you're learning in here and have another person to discuss with. Because that's one other thing. The other reason I started this group is because so many people going into retirement just don't have a good source of information nearby, don't have friends and family that are, amazing retirement planners. And so we created this community for you so that you can interact with other people that are going through situations you're going through, or maybe they already have been through them, and you can get that assistance and guidance you need to, again, make those steps forward with confidence. So today, I do want to talk about required minimum distribution. So let's get into today's training without further ado. Let's see here. Can you see this is my big question. Doesn't look like it so far. I just want to make sure that we are going to be good for our presentation. So I'm going to give this a second just to pull up. In the meantime, as a reminder, please go ahead and put your questions down in the comments section, and I will take a look at those as soon as I get a chance and as soon as we get through some of this training. So it looks like we should be good. All right. So really excited to share this with you today. This is something pretty much everyone in this group is going to have to deal with at some time. And what they are called is required minimum distribution. So what we're going to talk about today is how to calculate your first required payment and lower your distribution to pay less taxes. So we're going to talk about some strategies on how to lower your distribution requirements before 70 and a half, and some strategies that I know about that may be right for you, that may not be right for you, okay? Before we get into that, there is some disclosures we have to go over. I'm going to let this display for just a second. You can always go back, pause this, go through. Essentially, what I want you to take away from this is that this is not intended as investment, tax, accounting, or legal advice. So nothing like that. So please review this. If you have any questions, let me know. But today, let's get into this wonderful topic of required minimum distributions and help you get ready to make sure that you're maximizing your current situation. Cool. So the great thing about qualified plans like 401ks and IRAs is that you're able to contribute throughout your working career and avoid paying taxes on your contributions. So it's really, really wonderful because we can benefit from something called tax deferred growth. And tax deferred growth, if you've ever compared that to having a taxable account where you have to pay taxes on gains throughout the year, that can be very powerful. But one day the IRS is definitely going to want what's owed to them, okay? So it just is what it is. It's part of life. It's definitely a benefit to let your account grow tax deferred versus paying taxes when you look at the numbers if you had equal returns. But one day you are going to have to start paying out the IRS, and this is what we're going to talk about today. Okay, so how does the IRS ensures that they get their tax money? They do it through a process called the RMD, or required minimum distribution. Once you hit 70 and a half years old, you must comply with the minimum distribution rules. Failure to do so carries an extremely heavy penalty. If funds are not distributed by the required date, a 50% excise tax will be levied on you. So that's not good. So what that means is, if you fail to take your RMD in any year after 70 and a half, the IRS will impose a 50% tax on the amount that you were supposed to distribute. From what I have seen, if you mess this up the first year, you can kind of get like a one-time pass. But beyond that, you're probably going to have some trouble, or you're going to be doing a lot of fighting with the IRS, and that's never a good thing. So we want to avoid that. Okay. So as I mentioned, your first distribution must be taken by April 1st of the year following the year you turn 70 and a half. Or I guess I did not mention that, but you need to take your first distribution by April 1st of the year following the year you turn 70 and a half. So let's say you're going to turn 70 and a half this year in 2018. That means your first distribution will be due to be taken out by April 1st of 2019, okay? So it's great that there's a little leeway there, but I'm going to show you why you may not want to take advantage of this particular flexibility. It may not be good for you. But after your first distribution, for each year after, your RMD must be taken before December 31st of the tax year, okay? Really important that you do that. While waiting until April 1st for your first distribution can give you some wiggle room with your distribution timing, it can also do what's called that can also give you tax problems. Come on, buddy. My little program's a little slow today. Okay. So even if you comply with the April 1st rule, you still need to take your second distribution by December 31st of the same year. So this could cause what's called bunching of income, which means you're essentially taking two distributions in the same year. And the side effect of doing this could be an increase in your adjusted gross income, or your AGI. So this may cause you to pay more taxes than you would have. It could bump you into another bracket even than if you would have taken your distribution in separate years. So just be very careful with this. Again, you have the flexibility, but is it always the best thing to do? Probably not. So minimum distributions apply to assets in a qualified plan, an IRA, a 403B, a SEP IRA, a simple IRA, or a 457 plan. While minimum distribution rules do not apply to Roth IRAs, they do apply to Roth accounts that are in a 401k or 403B. So keep that in mind. If you decide to leave your money in your Roth 401k or Roth 403B and you leave work, the RMD will apply. A very simple way to avoid that is just to roll it to an IRA, but there are some benefits to 401ks depending on your situation, but you just need to know that. It's really important. Okay, there is an exception to the RMD, and this is if you are still employed by the plan sponsor. So the plan sponsor is essentially your employer. That's who that is, or whoever runs the plan. So if you're still employed by the sponsor or the plan sponsor of a qualified plan when you turn 70 and a half, if you are still working, you do not have to take your first RMD until April 1st of the year after you leave your employment with the plan sponsor. This exception is not available for any participant that owns more than 5% ownership of the plan sponsor. So again, if you're more than 5% owner of the company, so in the year you reach 70 and a half. Additionally, if you start taking your distribution, you cannot stop taking your distribution should you become less than 5% owner at some future date. So for you business owners, you got to think about this and make sure you understand this completely. So even though the law permits this delay, your qualified plan may require all participants to take the RMD at 70.5, even if you're still working. So you want to check something called your plan document. So if you have a 401k at work or whatnot, you're going to have something called a plan document, and that's going to lay out all of the rules that you need to know about. And so you just want to double check that, because your plan, even though the law may allow you to delay, your plan may not. So just be really careful with this and don't make this mistake, okay? So here's the formula for calculating your minimum distribution. Essentially, you're going to take the value of your plan assets, so the value of your IRAs altogether at the end of the prior year. So at December 31st of the prior year, you want to get the balance of all your different plans that are going to need RMD. And then you're going to divide that by what's called the life expectancy factor. Okay, the life expectancy factor, there's a table on the IRS website. If you just Google IRS life expectancy factor or IRS RMD distribution table, you should be able to pull that up without a problem. It's very easy to find. If you can't find it, let me know. I'll send it to you. And this is what it's going to look like, okay? So going back to this formula here, you're going to take the value of the plan asset, so that's the value of everything in the plan as of December 31st of the prior year, and divide it by the life expectancy factor, okay? So here are your life expectancy factors. So if you are, say, 70 years old when you're taking your first distribution, you're going to take the whole amount and you're going to divide that by 27.4. That's going to give you your required distribution for that prior year. Same thing down here. If you're 71, you're going to divide by 26.5. If you're 72, 25.6, and so on. So you just follow this table. Very simple. But you want to make sure that you calculate all of your IRAs, for example. So say you have 5 different IRAs. You can either take the required distribution all from one, or you can take the required distribution from each plan separately, whatever you want to do. It really doesn't make a difference. IRAs are treated as one big IRA in the way that this is all calculated, so not a big deal. But you definitely want to make sure you include all the different IRAs that you have when you're doing this calculation. So it may be multiple calculations that you're doing depending on your situation. All right. And then on this same sheet, you know, they essentially give you a little worksheet here. You're going to put your IRA balance right in this amount. You're going to take your distribution period from the table that I showed you on the previous screen. You're going to put that here. And you're going to take line 1. You're going to divide the number entered on line 2. And this is your required minimum distribution for the year. And then you are going to repeat steps 1 through 3 for each of the IRAs, okay? So let me take a quick minute to see if there's any questions on this so far. If you have any questions, go ahead and drop them down in the comments below. And we will take just a minute here, give people a chance to comment and ask questions. Again, if you do, leave them in there. If I don't get to them right now, then I will check on them later. And just so you know, if I'm looking down the whole time, it's because I'm checking on my phone, because you can't actually see both when you're doing this thing here. So give you guys just a minute to ask any questions. I'm currently not seeing any come in, so I'm going to continue on. But if you do, I will check again at the end of this training, and we'll go through your questions and answer them, okay? So here's an example for you. So this is John, okay? So John's account balance on December 31st, 2016 is $500,000, okay? And he will turn 71 by December 31st, 2017. Okay, so then, so John will then use a distribution period from the uniform lifetime table of 26.5, okay? Because he's going to use the number as if he was 71. So let me go back and show you that. So if he's 71, right here, you can see he's going to use 26.5, okay, to do the calculation. Okay, and what he's going to do is divide 500,000 by 26.5, and that means he's going to need to take a distribution for 2017 of $18,867.92 by April 1st, 2018. Okay, so this is what the calculation looks like: 500,000 divided by 26.5 is going to give you $18,867.92. So you do not want to make a mistake on that calculation, because if you are short, then you will have to pay a 50% tax on anything you missed. You can always take more, okay? So it's called a minimum distribution. So that means just a minimum you have to take. Maybe you need 30 or 40 or 50,000 to live off of every year. That's okay. That means you're going to be clear when it comes to your RMD, but you do not want to take less than $18,867.92 if you are similar to John. Okay, so here's a second example. So now let's assume John's account balance is $550,000 on December 31st, 2017, so a year later, and he took his 2017 distribution by April 1st, 2018. So for 2017, he will need to take $21,484.38. So again, we're just following the same formula, except now he's a year older. So instead of 26.5, it's now 25.6 that we're dividing by. So as you can see through the table, the number that you divide by goes down, which means the amount will go down or go up a little bit each year as you're taking it out. So the idea is that you essentially finish as close to zero. The IRS wants to get all their money, but if you do pass away before the table runs out, then you can pass that on to your heirs. So hopefully that's clear. If there's any questions, go ahead and put those in the comments below. Looks like I am getting a couple comments here. Let me see. For some reason, it's not letting me pull them up, and that's not good. Just a minute, folks. I do want to answer your questions, so bear with me while I check on this. Let's see here. And if not, I'll just have to go back in once we're all done and just answer them all. That's fine. Okay, gotta love technology, okay? You do what you can. All right, so here's the problem, is that he had to take two distributions in the same year. So he took his 2016 distribution or 2017 distribution early in the year by April 1st, and then he had to take the 2018 distribution at the same time. So now, or in the same year, I should say. So now he has $18,867, which was his previous one, and his current distribution is $21,484. So that's a total of $37,735.84. So if John was required to take all this money out in 1 year, so this is essentially bunching, right, in this first year, as you can see, that could potentially really affect the amount of taxes he has to pay. Especially if there's a spousal, if your spouse has IRAs, because these are called individual retirement accounts, which means if you have one and your spouse worked, that means they have an individual, I should say individual retirement arrangement, but then they are going to have their own individual. So you're going to have to take this money from all your accounts. And if you bunched up, two different people that were turning these ages in the same year, you could really throw yourself off when it comes to taxes and really pay more than you need to, instead of getting the timing right like you should have in the first place. So be very careful with this stuff, because paying an extra 10% in taxes is just not fun. That's your vacation money, that's your margarita money, that's your traveling to see grandkids money, that's your fun money that you could have had that now the IRS is owed. So not a good thing. I'm not against paying taxes to the IRS in the sense that if we're paying taxes, it means we made some money, but I never want to pay $1 more than necessary to the IRS. So making sure you get this right is very important, okay? All right. So if you can it's pretty obvious. You can notice how easily this could cause you to move up in the progressive tax bracket due to the stacking of two payments, especially if there are other sources of income. Okay, so you got to be really careful with that. Okay, now I want to talk to you a little bit about how to reduce RMDs. Okay, so if you are not 70 and a half yet, and maybe you have a few years ahead of you, here are some ideas on how to reduce your RMDs, which will essentially lower your taxable income when it comes time to have to take your RMDs, which at the end of the day, the more you can lower these, the more it's going to keep you away from having to pay extra money for Medicare and extra Social Security taxes and all these other things that may come up because you increase your income. So number one way that I think is good is doing a Roth IRA conversion. So Roth IRA conversions, so that's essentially when you take pre-tax assets that are in your traditional IRA, and then you transfer those to a Roth IRA, which then allows them to grow tax-free forever. You will owe taxes in the year that you did the conversion. But if you do it right and you do it on say on a year or 2 or 3 years between when you stop working and before you turn 70 and a half, then you can really do a lot of great things when it comes to avoiding and not paying taxes down the road. Another thing you can do is you can take IRA distributions until age 70 and delay Social Security. So you know me in this group, if you've been in here for any amount of time, I'm a big fan of recommending people delay their Social Security until at least full retirement age, and if not, all the way till 70, because it's very easy, $100,000, $200,000, $300,000 in additional retirement income. If you were to live to the average ages of, say, 86 or 88, you can hit those big numbers pretty quickly. I know there's a lot of people here that feel that they're going to pass away and they want to get their money from the government. Listen, if that's your prerogative, that's okay. But 50% of people are going to live longer than 86 and 50% are going to pass away earlier. If you make it to 78, you're probably going to hit a break even somewhere around there. So every year after that, you are going to have a significant amount more money coming in from Social Security if you do delay. So this is a great way to reduce the RMDs later by pulling from your IRA to cover some income, delay Social Security, and then wait until, say, age 70 to start taking Social Security, and that will reduce the amount that you'll have to take out at age 70 and a half going forward. You can also take IRA distributions and fund a health savings account. So we talked about health savings account, I think either last week or the week before, but these are wonderful accounts. I mean, I love health savings accounts. I find myself prioritizing the health savings account more than even extra money in the 401k these days, especially for younger clients, because you have so much time, and the HSA can be used for so many different things. And at the end of the day, we're all probably going to see a doctor at some point. And if you don't, then the HSA acts like an IRA, and you can just do tax deferred growth, and then, you know, again, you just pay taxes later like you would on an IRA. But there's no requirement to take out the money. There's no RMD in a health savings account, right? So you can move the money from your IRA to your health savings account, avoid the RMD later, and pay a little bit of tax up front. Number 3, you can take strategic RMDs before 70 and a half. So what that means is you time your distributions before 70 and a half, and maybe you take a little bit extra in 1 year, and then you take maybe 0 the next year. And so the way you can do that is you can time it and be strategic to where you save thousands of dollars on taxes by making sure that your distribution timing is done well. Another thing you can do, if you're still working, you can roll your IRA into your 401k. That's if your plan allows it. A lot of plans do. But if your previous plan allows you to roll your IRA into your 401k and you're still going to work past 70 and a half, well, that's a great way to avoid taking that RMD, because if you have to take it at 70 and a half and you're still working, that's going to be a pretty high tax bracket that you're paying out as well. So, and then if you are charitably inclined, and if you like to make charitable, qualified charitable distributions, you can do that from your IRA and just pay those right to your charity and avoid that money having to be taxed as an RMD later. So I think those are some really, really good things to consider when it comes to your retirement planning, especially if you're not 70 and a half and you have a few more years until this is going to come up, okay? So if you think any of these strategies might be right for you and you want some assistance with them, if you want to discuss strategies to reduce taxes throughout retirement, before retirement, and then into retirement, that's what we do. I would love to help you out with that. The best way to get started is to schedule a complimentary call with me. There is no charge for these calls. What you would do is go to kisplanning.com/apply. Once again, that's KIS, like keep it simple, planning.com/apply. And if any of those last 6 strategies I showed you have any interest to you, we can definitely discuss what it would look like on your distribution strategy to potentially save you thousands of dollars in taxes. I've seen tens of thousands and even $100,000 in taxable savings by getting your withdrawal strategy right. It's so much easier, from what I found, in accumulation. So for those of you that are still working, it's pretty easy. You put a certain percentage in your into your 401k. Maybe you can do a Roth IRA or a traditional IRA. You just throw the money in there. You put it in some investment. You'll probably be fine. But when it comes to taking out the money, the order that you withdraw is very, very important and could be detrimental if you do it incorrectly, okay? And you could pay tens of thousands more in taxes than you need to versus if you had a really good strategy from someone who understands this. So that's what we do. That's what I do, and I would love to help you out with that. And now I'm going to check to see if we have any questions and how I can help you out here, okay? So let's talk about that. If there's any questions here, let me see if I can pull it up here. Again, go ahead and put your questions in there. If anybody has any, please let me know. Okay, let's see. It looks like we got some questions in here. Wonderful. Okay. So Salma asked this question before the trading action. I wanted to get to it, so that's great. So she currently has a 401k with Prudential. Okay, quick comments. I'm not the biggest fan of Prudential. Their plans are typically very expensive, and the investments inside the plans are very expensive. So I already sort of know where I'm going to go with this one. But she says, when I retire, should I apply for the required minimum distribution straight from Prudential or roll it over to a savings bank or elsewhere? Okay, so you can if you want to do it from your 401k, if you like your 401k, if you like the investments in there. Generally, especially plans like from Prudential, Wells Fargo, things like that, they're very expensive. There's a lot of hidden fees that you may not realize inside 401ks, and those typically get passed from the plan sponsor, which is your employee, to the plan participant, which is you. So if you have a 401k and it's not from, say, a company like Vanguard or whatever, that's usually pretty low expense, you definitely want to consider rolling that over to an IRA. And then each year, you want to plan out your distribution based on the prior year at December 31st account balance, like I showed you here, and you take that number, divide it by your age factor, and that'll give you your requirement distribution. So great question. Hey, Brian, great to see you. Welcome to the training. Thanks for coming. Gary, thank you. Okay, Gary, I showed an example, so hopefully I showed 2 examples, Gary, so hopefully I helped you out there. If I didn't, if you don't understand something, please drop a comment in, drop a question, but I think we addressed that. Kathy says, or asks, can you take the amount out of any account as long as the total is right? Yes. So we covered that here. You can take it out of whatever IRA account you want. You can take it all out of one account, or you can take the distribution, equally, or proportionally, I should say, from each account separately and do it that way as well. Doesn't really make a difference, whatever you prefer and whatever's easiest. Okay. Linda says, I'm almost 73. Work 32 hours a week, I don't want to mention the number here unless you want to see it, but she has some money in her 401k. As soon as she retires, she needs to take payments out of 401k. What if you reduce hours to 16 or less? So if you're working at the same company, I would actually recommend you check the plan document for this particular plan. But if you're working at the same company, depending on what they determine in the plan document, you'd want to follow that. But in general, if you're working for the same company, you should be fine. You don't have to take anything out until you leave work. And then if you were to leave work, then your first distribution is required by April 1st of the year following the year you leave work. So let's say you're 74 years old, you leave work in October, okay? Well, then you're gonna have to take your distribution before April 1st of the next year. So in cases like that, it actually might make more sense to do the bunching where you take your first distribution before April, but in that same year, and then the second one later in the year. Because if you're working, earning a full-time salary, then you may pay a whole lot more taxes that way. So again, everybody's case is unique. I have to give you general principles, but that sounds like it'd probably be the right strategy for you, okay? Cheryl asked, is there a maximum amount per year that I can roll over from 401k to Roth? I have 3 years before 70.5. No, I mean, you can roll over whatever you want to roll to there. The big thing you want to be concerned about is the tax implications of what you're doing, okay? Here's the thing I want to talk about too, actually. I've seen this a lot lately. People hear all these things on the radio, these gurus that are quote-unquote personal finance experts. There's some really horrible advice out there, to be honest with you. People think that Roth accounts are always better, and in actuality, they're not always better. They do have their purpose. There are some benefits to them, but it doesn't make sense to pay 22 or 25% taxes now to put money into a Roth when you could wait until after retirement and pay 10 or 12%. Doesn't make any sense. So you really want to be careful and look at the tax planning implications and look at the numbers of what you're doing. I recommend you work with a professional. This is what I do. I see the value we provide every day, but I know some people, they feel like they could do it themselves, and that's okay. But don't always assume that doing Roth conversions or moving all your money to a Roth is always the best idea, because it's not. I love Roth accounts. I love the benefits of them, but it's not always the best thing to do depending on your situation, okay? So be careful with that. So Gary's asking, so I say it's best to take out money from a 401k and roll it to an IRA when you retire. No, that's not what I'm saying at all. I think it can be a good idea, but I think you want to look at your plan, and there are benefits to 401k. You have extra protections in 401k versus an IRA when it comes to lawsuits, bankruptcies, things like that. So if you're a business owner, there's a lot of things that could come up where your assets are more protected in a 401k. It's pretty close to the same, but technically there's more. And then also, if you leave your employer before 59 and a half and you're over 55, you can then take distributions from a 401k if you needed that to live on. But a IRA, you can't. You have to wait till 59 and a half. So it's not always better. So don't listen to that advice where you always take it with you, you always roll it. It can be, but again, your situation is probably unique. And so you want to treat it like that and get the advice for your particular situation. There's no set number of steps that you need to take and follow every single time. It's just not how it is, okay? Unfortunately, a lot of bad advice out there, but it is what it is. Alex asks, when you have a 401k, IRA, and Roth IRA, what is the correct order to take money out to fund early retirement? 51, planning to early retire at 55. Okay, that's a good question. So obviously, if you're 51, you're not going to be touching, if you're going to retire at 55, you're not really going to be touching the IRA unless you're doing what's called, if you're taking advantage of the 72T distribution. But, what you want to avoid during that time, or what you want to protect, is any sort of tax advantage growth. So again, Alex, it's going to depend on your situation. But generally, if you have some taxable assets that's outside of retirement accounts, that's usually a good place to start. Roth can be good to avoid paying taxes, right? Or to get the money out early, because you could technically take money out of your Roth, your contributions, anytime that you want. So that could be good. But at the same time, Roth assets are very well utilized on the back end, and those being the last distributions that you take, because as we're talking about today, there are no required minimum distributions. So finding the right strategy is going to depend, one, on how much income do you need to live off of, what size are your accounts, right? So what are we going to be looking at when it comes to things like RMDs or taxable distributions, and then also what other types of accounts do you have? Do you have some taxable money, right, between now and then? Or if you're 51 and you're going to leave at 55, what can you do now between 51 and 55 to set yourself up for that type of distribution plan, right? So there's no specific order that is great, or I should say that is perfect. But if you have those, again, you want to keep your tax deferred assets, or your tax advantage assets, I should say, protected as long as you can. So with that in mind, looking at taxable accounts first, I think is probably the best idea, depending on what you have going on, and then deciding between the other accounts from there. So hopefully that answers your question. If there's any other questions, go ahead and drop them in. But if not, that's what I have for you today, folks. Again, please, if you need help with this, don't sit there stressing yourself out, sitting in front of the computer, Googling for days, trying to find the perfect blog or the perfect calculator to give you this one answer. You need to get a comprehensive plan and an overall planning strategy when it comes to your exit, right? From your escape plan from work to retirement. There are many steps that can be optimized, and I'm not saying you can't fumble through it on your own. Plenty of people do. But when I speak to people, and I do every single week, there's not been one time where I found out somebody's plan was perfect and they couldn't have optimized a little bit more. Okay, so that's what I'm here for. I want to help you out with that. That's what we do. If you need anything, go to kisplanning.com/apply. And other than that, have a great week. I appreciate you guys so much. Thank you so much. Have a great, wonderful weekend, and I will see you in the group this week, and then also next week on our training. All right, have a great one. Bye bye.